So now that we've got this somewhat more sophisticated tree with different probabilities of up or down states, potentially inferred from past history, as well as different returns in these up and down states, up versus down 10% as before, let's see what happens if we actually combine two trees to essentially create a forecast 2 time periods ahead. So what happens is we start in our original value of 50. We can now go up. Remember, probability of going up is 2/3. And once in the next period we have realized the outcome of that period, let's say we did go up, all we do to create a 2-period model is we now just stack another tree on top of that. So now we have another 2/3 chance of going up again, or 1/3 chance of going up and then down. So if we go up 2/3 to state u, which we'll call that simply because it means that we've gone up, now we have a 2/3 chance of going up to state uu, and that would be sort of the end of the 2-time period model value that we would get to in that case. But with 1/3 chance we could go back down, and that would take us to state ud, which we would call that simply because it reflects that we first went up and then went down. Similarly, we could have gone down in the first period, remember a 1/3 chance of that, and then again we stack another tree on top of that first period outcome, which we'll call d because we went down. 2/3 chance of going up will take us to state du, which could potentially be different. In other words, we'll still say that there's technically 4 market conditions or 4 scenarios, either growth followed by growth, or growth followed by recession, or recession followed by growth, or 1/3 chance of recession and then another 1/3 chance of going down again, double recession. But really, if we look at the payoffs in each state, we'll sort of see that these middling states, up, down, or down, up, both get you the same actual payoff. So really, it's more like 3 states. What are the final payoffs? Well, if we gain 10% when we go up, that means that the payoff we get in state UU would just be our initial price, which was 50, compounded at 1 plus 10%, or 1.1, for 2 periods, getting us 60.5. Now, the payoff that we would get in states UD or DU is actually the same because the order of multiplication just doesn't really matter. We can multiply by 1 plus 10% and then by 1 minus 10%, or by 1 minus 10% and then 1 plus 10%. But in both cases, multiplying our original value of 50 by that will get us to final payoff of 49.5. And finally, the payoff that we would get in the state where we have recession followed by another recession would be 1 plus that negative 10% return that we incur each time, compounded twice, so to the 2nd power, multiplied by our original price of 50, getting us 40.5. Now that we have the 3 possible outcomes, either the stock is worth 60.5 or 49.5 or 40.5, what are the probabilities associated with that? Well, we can just calculate them using the definitions from our tree as well. So what's the probability of getting to state UU? Well, we first need to have gone up in the first period, so there's a 2/3 chance of that. And for now, we've assumed that these probabilities are independent. So in other words, there's just another 2/3 chance of going up the next time. So we just multiply those 2 probabilities together, and that gets us 4/9 chance of ending up in the state of growth followed by growth, state UU. What about ending up in the state UD, first having gone up and then going down? Well, the probability of an up move is 2/3, probability of a down move is 1/3. We multiply those together, and we get 2/9. What about the other state that really gets us the same outcome, du, probability of having gone down first and then up? Well, again, 1/3 times 2/3, another 2/9. But since those really get us to the same outcome, we can just add those together. So that's another 4/9 chance of ending up with this 49.5 as a payoff, either in UD or in DU. And then finally, what's the probability of going down twice in a row? Well, 1/3 times 1/3, 1/9. So we can take this 2-period tree, and we can actually equivalently now represent it again as a single-period tree, but notably with one difference. This tree has 3 possible state outcomes. And indeed, we can keep repeating this. We can keep stacking single-period trees at the end of this 2-period tree as well. We could, for example, have another tree here, and another here, and one more here. And this would take us to a 3-period tree that we could analogously represent now with a single tree with 1, 2, 3, 4 states. And we can keep drawing these out really as long as we like, and indeed in some sophisticated models of option pricing, for example, that's exactly what we do. And sort of intuitively, you can see that there is going to be less and less of a chance of us ending up in some of these tails, more and more of a chance of us ending up somewhere in the middle. Of course, since this probability tree is relatively asymmetric, there's in fact a high chance of us ending up somewhere around here, low chance of us ending up somewhere around there. And we can model a very large set of outcomes, because the more of these trees we draw, the more states we actually end up capturing, but still without the need to actually define some sort of continuous distribution function. So let's actually do this. Let's, as a practice application, draw a tree for 3 time periods. And also let's incorporate the idea of conditionality, in other words, the idea that the probabilities are no longer completely independent, such that our probability of moving up or down depends on whether we have moved up or down yesterday. And we'll see how that changes our tree. Okay, so how do we extend this event tree approach to 3 periods? Well, you can see here I've got a representation of our 2-period tree that we calculated already. Let's just take it out one more period. So if you end up having gone up twice, where would you end up if you went up for a 3rd time? Well, first of all, what's the chance of that? 2/3. Where did you end up? Well, you started at 60.5 and then you gained 10%. So you end up at 66.55. Now, what if you had gone up twice and instead you now go down? What's the probability of that? Well, we're just adding another single period tree, so conditional on having gone up twice. Now your chance of going down is just 1/3. And where do you end up in terms of payoffs then? Well, you've started at 60.5. You lose 10%. And that gets you 54.5. By the way, we can label these. This would be a state UUU, right? We go up thrice. This we could call UUD. But is this actually the only way to get to this state? Well, no, right? Because what if we instead had gone up from 50 to 55, then down from 55 to 49.5, and now we are to go up again, 2/3 chance of that happening. That should get us to 54.5 as well, right? Let's just confirm in a separate cell. If you start at 49.5, you gain 10%. Indeed, that gets you at 54.5. 54.45, I should say. So that means that there's really two labels for this state, UUD or UDU. And indeed, are there just two labels for this state? What if instead what happened is you go down from 50 to 45, and then up to 49.5, and then up again? We already know that 49.5 will get you to 54.5. So it means that there's actually a third path, and that would be DUU. And really you can now see that if the order of the paths doesn't matter, then however many different ways you can arrange the paths is how many different paths you have. What if you ended up at 49.5, you had gone up and then down? What if you go down again? Well, the probability of that is a third. Where does that get you? Well, you started at 49.5. You lose 10%. And it gets you to 44.55, and that would be called state UDD. But again, how many ways can you actually get to this payoff of 44.55? Well, another way you could get there is you could go down to 45, down to 40.5, and now you can go up. 2/3 chance of that happening. And now that would be GGU. And indeed, is there a third way to get there? Well, looking at the previous state we just considered, 54.5, there should be. What else would there be? Well, what about if we go down and then up and then down again? That would be DUD. All three of these will get us to this payoff of 44.5. And then finally, what happens if you had gone down from 50 to 45, down from 45 to 40.5, and then down once more? Well, that will get you to, you start at 40.5, you lose 10% yet again, and it gets you to 36.45. That is state DDD, and there's no other way to get there. Now, what would the probabilities of each of these outcomes be? Well, since they're independent, all we really need to do is just multiply them. So how many ways can you get to state UUU? Well, just once, just one way, and that would be probability of going up, probability of going up again, and probability of going up once more, 29.6%. What about these three states? Well, since there's three states, there should be three different ways to do it, which we have outlined already. So we better account for all three of them to make sure that our probabilities are sensible. So you go up, and then up again, and then down. That would be the first. And you go up, and then you go down, and then you go up. That would be the second. And you go up. Oh, sorry, you go down. And then you go up. And then you go up. That is the third. 44% chance of that. What about this one again? Three different ways. You go up, and then down from 55 to 49.5, and then down again from 49.5 to 44.55. That's the first way. You go down from 50 to 45, and then down from 45 to 40.5, and then up from 40.5 to 44.5. That would be the second. And finally, you go down, and then you go up to 49.5, and then you go down to 44.5. That's the third. And finally, how many ways are there to go down thrice? Well, there's just a single way, and it requires the recession state to occur thrice in a row. 3.7% chance of that. And now let's actually make sure that what we did is sensible, that we actually covered all possible outcomes. A good way to test that is that our probabilities actually add up to 1. And they do. Now, what would happen if we actually built in conditionality into this tree? In other words, what if we allowed the probabilities to change based on the prior path? This would sort of be a momentum-like behavior. In other words, if the economy went up yesterday or last period, it's more likely to keep going up. If it went down, it would be more likely to keep going down. And the way we can capture that is by saying that the probability of up given down, or sorry, up given up, is actually 75%. And the probability of down given down is going to be 50%. So in other words, if you went up in the prior period, you're even more likely to keep going up, and if you went down in the last period, you're more likely to keep going down. Remember, this vertical bar is the conditionality operator from statistics. Now, how does this change our tree? Well, on the outskirts of it, so to speak, in the most extreme branches, it's pretty straightforward. In other words, all it does is just, if we went up from 50 to 55, now the next probability of us going up is, instead of being 66%, going to be 75%. Now, what does that mean for our probability of going down? Well, of course, they have to sum to 1, so that goes down to 25. Similarly, the only way we can get to 60.5 is by having gone up the prior time. So that means that our chance of going up next period has gone up to 75 as well, and therefore the chance of going down has also decreased to 25%, that is. Now, analogously, if we go down the first time from 50 to 45, our probability to go down next time actually rises. Remember, it's now 50%, but of course what that means is that our probability to go up has fallen, because these probabilities, these two must sum to 1 as well. And if our probability to keep going down has analogously changed, that means that once we get down to 40.5, our probability to keep going is also 50% to keep going down, and 50% to keep going up. And that looks pretty good, right? Our probabilities still add up to 1. Now, is this actually still totally correct, though? Well, there's some conditionality that we haven't actually captured, because now some of these paths are actually different in terms of probabilities. What do I mean by that? Remember, there's 3 ways for us to get to the 54.45 payoff. We can go up, up, down, up, down, up, or down, up, up. If in the past, or if we currently think the probability of that is 34%, let's just confirm that by taking into account this momentum conditionality. So what's our probability of going along the UUD path? Well, the first time we go up that path, we get the 66% chance of that happening. Then for us to go up again, well, that is going to be the 75% chance, because now conditional on having gone up the first time, the probability of a further up move rises. And what about a down move? Well, that now falls because we have gone up in the past period. What about the UDU path? Well, the probability of going up in the first place is only 66%. Conditional on that, what's the probability of going down? Well, that's 25%. And conditional on that, what's the probability of going up? Well, remember, actually the probability of going down if you went down in the prior period is 50%. So probability of going up if you went down in the prior period is 50% also. And finally, what is the probability of following the DUU path? Well, the probability of going down in the first place is 33%. Having gone down in the first place, the probability of going up is only 50%. And after having gone up, the probability of going up yet again is 75%. So you can see actually that once we take into account conditionalities, the probability of ending up in the 54.45 state is somewhat different. But now our probabilities don't seem to add up to 1, so it looks like we've probably got to fix this state as well. Let's just set its old value aside for reference. Now what paths can we take here? Well, up, down, down means if we go up in the first place, there's a 66% chance of that. Then for us to go down would require a 25% conditional chance since we went up last time. And if we went down in the second period, the probability for us to go down in the third is going to be 50%. That's the UDD path. What about the DDU path? Well, the probability of going down in the first place is 33%. Having gone down in the first period, the probability of going down in the second is a higher 50%. And having gone down in the second period, the probability of going up in the third is a lower 50%. And finally, what about the DUD path? Well, the probability of going down in the first period is 33%. Having gone down in the first, the probability of going up in the second is reduced to 50%. And then having gone up in the second, the probability of going down in the third falls to 25%. And now we see that the probability of ending up in this lower 44.55 state is a little higher than we had erroneously assumed if we actually thought that all the paths were still the same. But now all of our probabilities of ending up in each of the 4 possible states now sum up to 1 again. So at bottom, conditionality makes your trees far more complicated because now there's actually not really such a neat path from any of these intermediate nodes, because you actually have to take into account conditional probabilities that will vary depending on how you got to this intermediate node in the second period. Okay, so now we see how far this has sort of gotten us in terms of this process for portfolio selection. We have gotten a sense of what assets we might want to include, and now we have a range or probability distribution of the returns of these assets, and we have also simplified this probability into a tree. Now, how can we use the same approach to characterize the weights and payoffs of a portfolio of assets?